Hey everyone, and welcome to today's Explainer. Today we're zooming in on an absolute titan of the aerospace industry, Safran SA. Keeping the world's commercial fleets in the sky is literally a massive undertaking. And well, Safran just posted some absolutely record-breaking results for the first half of 2026. We're going to unpack exactly what these numbers mean, and more importantly, what they signal for investors going forward. Let's get into it.
Here's how we're breaking things down today. First, we'll look at those record H1 results. Then, we'll map out the key engines of growth. After that, we'll navigate the potential risks on the horizon, and we'll wrap it all up with the current analyst consensus.
Okay, let's dive right into this first section, record H1 2026 results, where Safran really just soared past expectations.
Take a look at this massive headline number. For the first half of 2026, Safran raked in 17.57 billion euros in revenue. To put that into perspective, the broader market consensus had them pegged at 17.47 billion, so they cleared that hurdle with room to spare. Now, in an industry where, incredibly complex supply chains and long lead times are just part of the daily grind, beating top-line estimates by roughly 100 million euros, that's a powerful indicator. It shows robust demand and, crucially, some seriously exceptional execution on the factory floor.
But hey, top-line revenue is only half the story, right? The real magic happens when that strength flows all the way down to the bottom line. And that brings us to this wild figure, 29%. Safran's recurring operating income didn't just inch up, it surged 29% to hit $3.24 billion. And because of that massive growth, their operating margin expanded to a record-breaking 18.4%. Actually, think about that for a second. In heavy manufacturing and aerospace, hitting an 18.4% operating margin is just a massive testament to their pricing power and some incredibly tight cost controls.
So, riding the wave of this phenomenal cash generation, management stepped up and confidently upgraded their full-year 2026 outlook across the board. They're now projecting mid-teens revenue growth for the year. Even better, they're guiding for a free cash flow of between 4.7 and 4.9 billion and expecting operating profit to land somewhere between 6.4 and 6.5 billion. When a blue-chip player with this kind of massive market footprint raises guidance this aggressively, it's a huge flex. It signals profound confidence in their order book for the rest of the year. Now, let's break down where all this cash is actually coming from. The propulsion segment is undeniably the primary engine here, pun totally intended, delivering a 21.7% increase in revenue. That was heavily fueled by a 41% jump in LEAP engine deliveries. Meanwhile, the equipment and defense segment showed some really solid muscle with a 23.6% jump, greatly benefiting from higher original equipment volumes, specifically for the A320neo. And then you have aircraft interiors. Historically, the smaller segment has faced some restructuring headwinds, but even they pulled their weight with steady 6.6% organic growth and expanded margins up to 3.7%. So literally, every single division is rowing in the exact same profitable direction.
Moving right along to Section 2, Key Engines of Growth. Let's look at the structural drivers behind these numbers.
If you take away just one operational fact from this whole explainer, make it this one: structural aftermarket strength. This right here is the absolute lifeblood of Safran's profitability. Look, in the aerospace game, you sell the engine, sure, but you make your real money on the decades of maintenance and spare parts that follow. This aftermarket generates significantly higher margins than selling the original equipment. In H1 2026 alone, Safran saw their civil engine spare parts and services surge by over 40%. When you combine a massive aging installed base of their older CFM 66 engines with a rapidly growing fleet of newer LEAP engines flying every single day, you create a deeply resilient, recurring, and honestly, a highly lucrative revenue stream.
And this brilliantly illustrates exactly why that aftermarket is so strong. Through their CFM joint venture with GE, Safran commands roughly 70% of the global narrow-body engine market. 70%! That is an absolute stranglehold on the most highly utilized aircraft category in the entire world. Every time a huge majority of the world's single-aisle planes take off, Safran is generating value. This dominant market share is the absolute bedrock that makes their aftermarket growth so reliable.
But Safran isn't just resting on its laurels here. They are actively future-proofing this dominance with the RISE program. RISE stands for Revolutionary Innovation for Sustainable Engines. Management has reported some really incredible progress on this front, having already completed over 5,000 endurance cycles. This next-gen technology is purpose-built to lead the next major single-aisle engine replacement cycle. So while they're definitely cashing in on today's fleet, they are perfectly positioning themselves to be the undisputed supplier for the sustainable fleets of tomorrow.
Furthermore, management is fiercely disciplined when it comes to capital allocation. They absolutely know how to reward their shareholders. Thanks to that massive cash flow we just talked about, Safran repurchased about 2.6 million shares in the first half alone. That's $804 million returned, scaling up to $875 million by late July. And of course, buying back shares reduces the total count, which directly boosts earnings per share. Add in a solid dividend policy, and it's really no surprise that S&P upgraded their credit rating outlook to positive back in July 2026. Structurally, their financial health is ironclad.
All right, time to shift gears a bit. Section 3, navigating potential risks, because there is definitely some turbulence ahead.
The source materials outline 3 specific key risks that you need to monitor closely. First, a demanding premium valuation that might limit upside. Second, severe supply chain bottlenecks tangled up with geopolitical tensions. And third, the direct impact of shifting tax policies over in France. Let's break these down one by one.
Now, what's really interesting about this number here is that Safran currently trades at a price-to-earnings ratio of around 30. In the aerospace sector, that is a distinct premium valuation. Now, it's somewhat justified by their high returns on equity, for sure, but trading at 30x means the market is basically pricing in perfection. If Safran hits any execution missteps, or if there's a sudden negative surprise, there is very little padding to cushion the fall. The stock is essentially priced for a flawless landing, and that is a real inherent risk.
The second major risk comes from the physical, nuts and bolts reality of building these engines. As a global defense and aerospace supplier, Safran is highly exposed to geopolitical tensions, which includes the ongoing conflict in the Middle East. Plus, persistent supply chain bottlenecks, especially when it comes to securing raw materials and specialized forging parts, remain a very serious daily headache. If they can't get these components on time, it severely threatens their ability to ramp up production to hit their aggressive Rate 75 targets. That's 75 aircraft per month for the A320neo program. Finally, we have to talk about the regulatory and tax environment. The company's 2026 guidance absorbs a $500 million hit specifically from the French corporate surtax. Looking at this impartially based on the data, while this $500 million is indeed already factored into their upgraded guidance for the current year, management explicitly noted that this tax is not modeled into their long-term guidance. So, if the French government decides to extend this surtax or make it permanent, that would act as a direct, unmitigated drag on Safran's long-term earnings potential. Moving into our final segment, Section 4, the Analyst Consensus. Let's see what the market verdict actually is.
According to a sample poll of 22 analysts dissecting these H1 results, the overall sentiment remains strongly positive. Out of those explicitly highlighted, we see 9 analysts assigning a buy rating compared to just 3 holding a hold rating. It's pretty clear that the majority of the professional analyst community believes this structural growth story heavily outweighs the near-term valuation and supply chain risks.
But when we look at the specific price targets, a really fascinating debate emerges. The average 12-month consensus price target sits between 343 and 347, which implies a fairly modest 2 to 10% upside from current levels. However, look at the massive spread in opinions here. You've got RBC Capital taking a highly bullish stance with a $400 price target. But on the flip side, you have Jefferies and Morgan Stanley holding much more conservative targets at 310 and 305 respectively. It's a classic tug-of-war between amazing growth potential and strict valuation limits.
So the crucial point is how these two camps view the exact same set of data. The bullish view is totally laser-focused on Safran's stellar execution, that 70% dominant market position, and the massive long-term runway provided by both the aftermarket and the upcoming RISE program. The bearish, or I guess more cautious view, doesn't actually doubt the underlying quality of the company. Instead, it centers purely on that 30x premium valuation. They argue the upside is capped by geopolitical uncertainty and the very real execution risks of hitting those Rate 75 production targets while battling supply shortages.
So what's the core thesis of this explainer? Well, the data makes it undeniable. Safran is an incredibly high-quality aerospace champion. They have exceptional operational execution and a crystal-clear path to long-term growth. But that quality is incredibly well recognized, and it's already heavily priced in today. Because the market is expecting perfection, the stock is definitely susceptible to volatility. For focused investors, this is fundamentally a robust company, but one that requires you to watch closely and perhaps be opportunistic on any market dips.
I want to leave you with this final thought to ponder. We've seen their absolute dominance in today's skies, and we've seen their massive cash flow. But considering the premium price tag required to own a piece of this engine giant today, you really have to ask yourself, with the revolutionary next-gen RISE program on the horizon, is Safran's premium valuation actually justified for the true long-term investor, or is the runway for near-term growth already fully booked?
Thank you so much for joining me in this explainer. Keep asking the big questions, keep diving into the data, and keep learning.